Howdy, y'all. Welcome back. It's the Liberty Call for Wednesday, January 5th, 2022. I apologize for not having a broadcast yesterday. The interwebs went down here yesterday afternoon, and unfortunately wasn't able to produce a broadcast. So I do have a few more articles and stories that I'm going to cover today. So I do apologize if this does go a little long. So, but I am making up for yesterday. So hope everyone's having a wonderful hump day out there in the interwebs. It's another gorgeous day here in Colorado. There's still about, 3 or 4 inches on the ground outside. We had probably about 8 inches over the weekend, and which was pretty nice. I haven't had a heavy snow here in some time, and got to break out the snow blower on, what day was that? Sunday, I guess. Yeah, Sunday. Cleared the driveway, cleared the cars. And also got my fifth wheel winterized again. I did have a one part did freeze up and cracked. It's a little filter bowl that filters your water as it comes out of the spigot. It exploded, so I got to replace that. So plus, we all, like I said last week, one of the roof vents or skylights in the high winds we were experiencing Monday a week ago ripped that damn thing off. So right now it's got Gorilla Tape across it to keep out the snow and the moisture. But as soon as we get some decent weather for a few days, I got to order the part, and then B, I got to get back on up there and replace it. All right, well, let's go ahead and jump into the news for the markets for today. Let me see if I can make this a little bit bigger for y'all to see. Oops, too large. All right. Okay, so the Dow Jones today was down 1.07. It was up most of the day until the afternoon. The S&P 500 was down 1.9. NASDAQ was down 3.34. Small caps were down 3.35. Not sure why that's popping up. Let's see, across Europe, it's kind of mixed. We had green across Germany, Britain, Europe. Yeah. So, and then let's see, across Asia last night, we had mostly negative numbers ranging from about down 0.25 to as bad as down 1.79. So all in all, it looks like the markets were kind of mixed. Today's markets, like I said, were up most of the day until the Fed minutes came out, and then the markets completely plummeted. All right, so I got some articles here. First one, stock market news live update. Stocks drop, tech shares sink after Fed minutes. Hint at earlier liftoff on interest rates. NASDAQ slides by 3.3%. Okay. Technology stocks came under renewed pressure on Wednesday, while the Dow Jones Industrial Average pulled back from a fresh record high, with investors turning away from tech and growth stocks in anticipation of higher rates. The S&P 500 declined to pull back further from Tuesday's record high, intraday high. The Nasdaq underperformed against all the other two major indexes. Apple shares built on losses from a day earlier, bringing the stock back down further after reaching a $3 trillion market capitalization for the first time ever at the start of the week. Investors eyed the Fed meeting minutes from the FOMC meeting in December, which suggested that the central bank was considering a faster removal of its monetary policy accommodation than previously anticipated. Policymakers suggested that against the backdrop of a firming economic recovery and elevated inflation, interest rates could rise sooner than anticipated, and some policymakers also telegraphed they would opt for shrinking the Fed's balance sheet soon thereafter. Participants generally noted that given their individual outlooks for the economy, the labor market, and inflation, it may become warranted to increase federal funds rate sooner or at a faster pace than participants had earlier anticipated. The minute said some participants also noted that it could be appropriate to begin to reduce the size of the Federal Reserve's balance sheet relatively soon after beginning to raise the federal funds rate. Investors Wednesday also digested fresh, upbeat economic data as private payroll gains handily exceeded estimates for December, ADP said Wednesday that the private sector added 807,000 jobs during the final month of November, uh, nearly doubling expectations as job growth picked up to help alleviate some labor shortages. In the first few trading days of the new year, investors have piled into cyclical areas of the market with shares of companies seen as the biggest beneficiaries of firming economic recovery and rising interest rates outperforming. The energy, financials, and industrial sectors outperformed the S&P 500 on Tuesday, and the Dow Jones Industrial Average, composed heavily of cyclical stocks, rose by more than 200 points to set an all-time closing high. Treasury yields jumped to begin on gains after moving sharply higher on Monday and Tuesday, which added pressure to technology and growth stocks valued heavily on future earnings potential. The benchmark 10-year jumped to a 9-month high following the release of Fed meeting minutes Wednesday afternoon. Yields are moving sharply higher or in the very recent past, but they have been stubbornly lower when you compare them to what the inflationary talk has been. There's been a lot of discussion about runaway inflation, the Fed being behind the curve. All of that would translate to a long end, to the long end, the 10, 20, and 30-year portion of the yield curve. That's a lot steeper or materially even higher in absolute terms than it is right now. Meanwhile, Eddie Gabor, founder of Key Advisors Group and author of Common Sense Bull, told Yahoo Finance he expected the move higher in rates so far this week would ultimately prove to be a head fake. The increase in rates doesn't concern me at all. I think it's going to be short-lived, he said. The bigger concern I have right now is the fact that a lot of investors are still carrying a tremendous amount of risk heading into a year that's going to be unprecedented. When the Fed is tightening down during a slowdown, it's usually not a good recipe for high-risk assets. So definitely some interesting views there. This person's, what was his name? Eddie Gabor seems to think that raise or interest rates going up is going to be a short-lived thing, probably because the market will probably could potentially fall apart, and then the Fed's going to come to the rescue and try to save everything all over again. All right, Fed minutes flag chance of earlier hikes and a balance sheet rundown. It's probably some of the same things we just talked about, but let's read through this. Federal Reserve officials said a strengthened economy and higher interest or higher inflation could lead to earlier and faster interest rate increase than previously expected, with some policymakers also favoring starting to shrink the balance sheet soon after. Participants generally noted that given their individual outlooks of the economy, the labor market, and inflation, it may become warranted to increase federal funds rate sooner or at a faster pace. Yeah, we just talked about that. Some participants also noted rate forecasts. Fed officials were also unanimous in expecting they would need to begin raising rates this year, according to anonymous projections published after the meeting. That marked a shift from the previous round of forecasts in September, which had shown the FOMC at the time was evenly divided on the question. The minutes stopped short of providing explicit guidance on the timing of the liftoff following almost 2 years of near zero borrowing costs. Neil Dutta, head of the U.S. economics at Renaissance Macro, took the minutes as a sign that the Fed is on a glide path to a March rate hike. That the Fed is signaling it might be appropriate to go sooner is giving them the go-ahead for a March hike. Dutta said, I expect them to announce the runoff before year end. Fed Chair Jerome Powell, in a press conference following the December meeting, said recent inflation data informed the changes. U.S. consumer prices rose 6.8% in the 12 months through December, according to Labor Department figures, marking the fastest pace of inflation in nearly 4 decades. At the time of the meeting in mid-December, before Omicron variant had surged more widely throughout the U.S., Fed officials generally saw the strain as adding to inflation risk, according to the minutes. Omicron impact, rising housing costs and rents, more widespread wage growth, and a more prolonged global supply bottlenecks, which could exacerbate by the emergence of the Omicron variant, fueled changes to officials' inflation outlooks, the minute said. Since the meeting, Omicron has spread rapidly throughout the country, disrupting airline travels and schools while also presenting challenges to restaurants and other businesses. Fed officials received a briefing from staff members on issues related to the normalization of the central bank's $8.8 trillion balance sheet, During the last rate hike cycle in the 2010s, the Fed waited almost 2 years after liftoff to begin trimming assets. So, I mean, what are they going to do now? I guess is really the big question. Are they going to start trimming that balance sheet, say the second quarter or third quarter of this year? Or is this something that they're going to procrastinate on and like they did the last time and wait several years before starting to sell off those assets? I would guess that they will probably delay it. That's typically the way the Fed does things. They typically will kick the can down the road as far as possible so that they're not the ones having to make that decision. So, but we will see.
Time for the word on Wall Street.
This is the dangers of a wait and see approach to inflation. This is from Fox Business Live. So let me increase the speeds here so it'll be a little bit faster. Let's go ahead and listen to this for a couple minutes and see what their opinions are on this.
Top investors watching your money this morning. Joining me now, Lafler Tangler Investments President Arthur Laffer Jr., Markowski Investments President Chris Markowski, and the Fitzgerald Group Principal Keith Fitzgerald. Arthur, let me start with you. Futures are searching for direction this morning. We're waiting for the Federal Reserve minutes from December, from that meeting, out in just a few hours. The minutes could give investors a better picture of where these policymakers see interest rates going in 2022. Fed officials forecasting 3 interest rate hikes by the end of the year. You say the Fed, Arthur, is taking a wait-and-see approach to inflation. How dangerous is that?
Well, if inflation doesn't slow down, it's going to be a problem because then they're going to have to act a little bit more aggressively. But the Fed's a political animal, so this is what you should expect from them. They're going to wait and see what CPI looks like in December and January 1st before they give us an indication whether you're looking at 2 or 3 hikes. I think it's probably more likely. Because
it seems to, we had a guest on last hour who thinks that it will be the Fed will be less aggressive at reining in inflation because growth will be weak. But are investors, like the Fed historically makes mistakes when they try to remove accommodation. And do you see that in the cards, particularly when you have asset inflation, asset bubbles here, there, and everywhere?
Yeah, definitely. I mean, the Fed has historically not acted ahead of the market. What they do is they really don't want to take off the gas. They like the gas in the economy, like being accommodative on credit. So, and also this Fed's a lot more dovish than it was before. The new membership really gives it even more of a dovish tilt to it. So, it took them how long to take transitory out? They're going to really wait until they really think the fire's going on inflation, if that's the case. So, yeah, I wouldn't expect the Fed to be aggressive at all.
Keith, you say inflation splits are here. Investors don't tech stocks like Apple, Microsoft, and Tesla. You say this is a bad move. Why?
Well, I think that you got to think about it logically. Tech is improving every aspect of our lives. They're changing the way they eat. They're changing the way they drive. They're changing how they think about buying houses. But nobody that I know of is giving up their iPhone. Nobody's giving up their wearables. Tech is increasing medical technology. 91% of investors or executives think it's a primary investing area. 82% think AI is there. Cybercrime is already so big that if it were a country, it'd be the world's 3rd largest GDP. Microsoft, Apple up 500% in the last 5 years. Do you want to switch horses in the middle of a race if you're winning? I don't think so.
Chris, we learned a record 4.5 million workers quit their jobs in November. Job openings did fall from about 11 million to 10.6 million. This, as the December jobs report is coming out on Friday. What are you expecting, and what's the impact from the jobs report, but what's the impact on the market?
Well, the impact on the overall market, right now is basically muted to some degree. We've obviously seen the markets rise, the old Santa Claus rally coming up. I'm looking more to what's happening in the future. You just did a story. We're talking about Chicago school districts shutting down. What does that mean to all the parents out there that will have to scramble, that can't go to work? This great resignation could continue moving forward. And I know it's anecdotal, but many of my clients are small business owners all around the country, and they're having a really difficult time finding workers. And yeah, there's certain areas of the country had a real tough time. New Year's Eve shutdowns in the Northeast and some of these urban areas. But this is going to start, morphing into other areas of the country as well. This will make it more difficult moving forward.
But wouldn't it be temporary, and the market would probably look past that?
Well, the markets are looking pretty much past everything, at this point in time. You're taking a look at what's going on and what's happened via the Santa Claus rally. I think the markets are trying to see what the Fed is going to be doing moving forward, get the minutes coming out a little bit later on today. But even with the Fed, I highly doubt that they're going to really do much outside of 75 basis points this year, which basically is akin to cut your grass with a pair of scissors.
Right. You're still staring at a balance sheet about almost $9 trillion. Before the financial crisis in 08, it was 800 billion. Really astonishing. Thank you, gentlemen. Chris, what were you going to say before we go?
No, I was just going to say, what can the Fed do? Our national debt is almost $30 trillion. Can they really raise rates? I mean, they're stuck in a box.
Keith, you're shaking your head.
The Fed is so far out.
All right. So definitely seems like some mixed opinions there from the 3 gentlemen who were the guests on that video. But I think the thing that they would definitely agree on is that interest rates aren't going up that much. Like the last gentleman who spoke said that, if we're up to, say, 75 basis points a year from now, is that really going to make a dent in the inflation that we're experiencing? My guess would say no. But hey, I'm just some guy sitting here in the mountains. What do I know? All right. Well, let's go ahead and jump over to the next one, this is definitely some good news that has been talked about. Uh, this has to do with the December jobs growth number that came in at 807,000. So let's go ahead and listen to what this guy has to say.
ADP reporting that the private payrolls for the month of December rose by 807,000, revising down slightly. It's stronger than the BLS number for November by 29,000 to 505,000. Looking at the details, you can see this number is more than double the estimate. Total private payrolls ADP was estimated to be 375 by the street. It's coming in at 807 with very strong gains in the service sector, up 669,000, and also good gains in the goods sector, 138,000. You can see the non-farm payrolls, 422,000, is certainly light compared to where the ADP estimate is. Looking at it by business size, large businesses did the bulk of the hiring, up 389,000, but still good growth among small and medium-sized businesses as well. 204 for small, 214,000 for medium-sized businesses. And then looking at by industry type, well, you can see you have the job growth where you might expect it. 246,000 in the leisure and hospitality sector, trade, transport, utilities, 138, professional business services, 130, education, health services, and manufacturing also doing well. It is worth here reading a quote from Neil Richardson, chief economist at ADP, who wrote, "December's job market strengthened as the fallout from the Delta variant faded, and Omicron's impact had yet to be seen." You remember I reported yesterday that there is some sign in some of the high frequency data that maybe the Omicron showed up in the jobs data as soon as the December job report, but certainly thereafter. And we'll wait to see. I would not have been surprised.
All right. So definitely some good news there as far as the jobs numbers came in, double what we were expecting, at least what the analysts were guessing that they were going to come in at. So that is definitely some good news. And let's see, I got one more video I want to share. This has to do with, get good news in one video and then bad news in the other. 4.5 million people left their jobs in November. So let's go ahead and take a peek at this.
A handful of industries are standing out among those where workers are doing the most quitting. A million workers walked away in November from the leisure and hospitality business. Most of those from restaurants and hotels. 686,000 retail workers said goodbye to the boss, and there were great numbers of resignations in healthcare and manufacturing. The general theme seems to be those industries that lost the most workers in the pandemic, they're having the hardest time keeping people. And both leisure and hospitality and retail, well, they're known for being lower paid industries. While there have been raises, they don't appear to be enough, Kelly, to keep workers from walking out the door and saying, take this job and...
Well, we have to be seeing the impact of Omicron here as well.
Yeah, we are. It shows up in jobs, school closures, and airline flights. So there's just a few places here. You reported last night 3,200 school closures around the country. Well, according to Burbio, 300 more schools closed today. So that's north of 3,500 right now. Job growth looks to have been hurt during December somewhat by Omicron. That could continue into January. And with all those flight cancellations, airline passengers processed by TSA still 15% below the pre-pandemic level. Now, the hope is that the virus's economic effects are short and not particularly acute, kind of the way people are describing how the virus itself is affecting them personally. If so, we could see a rebound of the data as soon as February.
All right. So again, some good news, some bad news. I mean, I know when I go out in the public, there's go to a restaurant. Where were we the other day? They said, it was on Monday when my wife and I went out for late lunch, and they were saying that they're short staffed, and there's some things on the menu that may not be available. So I mean, these are problems that everybody's dealing with. So, but hopefully, long term, people get their butts back to work. So. All right, so I do have two more articles I do want to blaze through real quick. The first one, the best job in America, pays up to $125,000 a year and has 10,000 job openings. So for people out there who maybe you hate your job and or you hate what you're doing for a living and you feel you're not compensated appropriately, this might be. The last 2 years have been a perfect time to retrain yourself, get some better skills, and re-enter the workforce in a position that either you feel compensates you for your worth, or you enjoy more, you enjoy it more. So, all right, most people want to find a job that keeps up with inflation and provides some of the best work-life flexibility, but they also want to be happy. After all, most Americans spend at least 8 hours a day working, and often without paid time off. It's the $125,000 question in increasingly unpredictable labor market. How can you have it all? Is there a career that comes with the prospects of a six-figure income, high job satisfaction, and has enough job openings to make it a real possibility? Workers quit their jobs at a record pace in November, suggesting that people are fed up. The number of quits increased by 370,000 to a record 4.5 million in November. The quit rate rose to 3% from 2.8% in October. At the same time, job openings fell by 529,000 to 10.6 million on the last day of November. The Labor Department said this week. Economists polled the Wall Street Journal. Economists polled by the Wall Street Journal had forecast a gain of 11.1 million vacancies, let's see here. Computer scientists remain in high demand. Companies are always keen to use Intel to improve efficiency and learn more about their customers. And so computer scientists are in high demand. They are one of the privileged professions to have the opportunity to work remotely. Java developers were number one on Glassdoor's 50 best jobs in America for 2021. They typically work at startups focused on creation of web applications to market and to fill existing customer orders. They boast a salary range of $69,000 to $125,000 and have a median base annual salary of more than $93,000. They had a 4.2 out of 5.0 job rating, and there are approximately 10,103 job openings for Java developers. Java developers ideally have a bachelor's degree in computer science with a professional IT certification and are required to have expert level Java programming plus experience in database management and computer architecture. Data scientists were number two on the list. They were followed by data scientists at number two, 113,736 median annual base salary, and product managers at number three, 121,107. Enterprise architects at number four, 131,361, and DevOps engineers at number five at $110,003. Data scientists and software developers use programming languages such as Python, followed by R, SQL, and Hadoop. not familiar with that one. And more well-known Java. Product managers are responsible for the strategy and blueprint of a product or product line. An enterprise architect is responsible for the company's entire IT infrastructure, while DevOps engineer is proficient in both engineering and coding and creates and implements system software and improves existing systems. These computer scientist positions are in high demand across all industries, career consultants say, particularly at Silicon Valley companies such as Meta, which used to be Facebook, Alphabet, and Microsoft, among many others. The Glassdoor job score is determined by weighing three factors equally: earnings potential, the median annual base salary, overall job satisfaction rating, and number of job openings. C-suite and intern level jobs were excluded from this report. For a job title to be considered, it must receive at least 100 salary reports and at least 100 job satisfaction ratings shared by U.S.-based employees in 1 year. Results represent job titles that rate highly among all those three categories. Computer scientists have competition. A separate report by U.S. News and World Report on the best jobs of the year listed physician's assistants at number one, 112,000 median salary and 39,000 openings. Software developers were number two. That report's definition of best jobs may sound familiar. They pay well, they challenge us year after year, match our talents and skills, and aren't too stressful, offer room for advance throughout our careers, and provide a satisfying work-life balance. So some food for thought if maybe you hate what you're doing, or maybe you're tired of busting your knuckles and you want something that's you get to work indoors, or maybe the opposite. Maybe you're tired of sitting at a computer and you want to learn how to be a welder or a plumber or whatever. That might be something to think about. All right. And then this last article is a Finnish man passes on paying $22,600 to replace his Tesla battery and blows up his car instead. There are times in life when you have to choose between paying a boatload of money or watching a very big explosion. Well, not really, but Finnish man Tuomas, Tomas Katainen sure did. Katainen is a 2013 Tesla Model S owner who was told he would have to pay more than $22,000 to replace the battery on his car. For him, it apparently wasn't worth it, so he decided to team up with a YouTuber to blow up his Model S with 66 pounds of dynamite instead. According to Katainen, his Model S ran excellent for the first 932 miles after he bought it, but then error codes started to appear. He sent his car to the Tesla dealer's repair shop, where it remained for about a month, and was told they couldn't do anything for his car. His only option would be to replace the entire battery, which would cost more than $22,000. And he would have to ask Tesla permission to carry out the repair. To put this in perspective, $22,000 would go a long way to buying a used 2013 Model S in Finland, which appeared to sell for more than $42,900. But Katainen decided that's not for him, providing that there's indeed a thin line between logic, rage, and insanity. So I told them, I'm coming to pick up the Tesla. He said, now I'm going to explode the whole car away. So here's the video of this. Let me see where it starts.
Ja niin, mun mielestä sulla on ohjeet siihen annettu, eikö niin?
And I don't speak Finnish.
Sitten on jotain yhteinen countdowni.
Here we go.
3, 2, 1!
All right. Well, that was probably a good use of funds. So, I'm making light of this. It is a bit of a funny story, but this is probably the biggest problem I do see with the electric car market is that the batteries are very expensive, and the replacement costs and time down without your vehicle is definitely something to think about. While I'm not opposed to alternative energies or vehicles that run on something other than diesel or ethanol, hey, it's until we really seem to get vehicles that can be repaired and replaced quickly or inexpensively. I don't know if the gasoline or diesel vehicle is really going to go away anytime soon. So we'll see. All right. Well, I have rambled on for 26 minutes. I hope everyone has gotten something from this. If there's anything you need from me, don't hesitate to email or drop me a phone call. And I'll be back tomorrow, hopefully, as long as there's internet at the house. And we'll talk to you then. Bye-bye.